Right. We are going to continue with where we left last time. So we were looking at the miscellaneous standards, and out of which we looked at LKS 21, which talked about the foreign exchanges and the rates, effect of changes in rates, and what is a functional currency, presentation currency, and then we spoke about closing rates, spot exchange, all those, and we also went on to look at the definitions and how do we take account of the revaluation gains or losses, or we call them also as revaluation gains or losses. And in the case of a foreign operation, we call them as foreign currency translation, or again you might call it as foreign currency revaluation. So then we went on to look at another topic, which is on accounting policies, changes in accounting estimates, and errors. This is covered under LKS 08. Now, when we talk about LKS 08, it forms the basis for how an accounting policy should be drafted and what are the impacts on financial statements when you go and change accounting estimates and how those should be adjusted. These are the things that are covered under this particular accounting standard. So the objective of this standard is to prescribe the criteria for selecting and changing accounting policies, right? So you know what are accounting policies now. Especially I explained you all how a depreciation policy would look like, right? And I also showed you how a policy is defined in the financial statements. Okay. So what happens here is when a company discloses its financial statements, there is a requirement for them to disclose the accounting policies and if there are any changes in accounting estimates, and also if they correct any errors, right? Say from one particular financial year to another financial year, you go and correct an error. Then when all these happens, you need to provide additional disclosures. That is very, very important. That is, you go and provide additional information to the reader to justify your case. Justify your case. That is, you change the accounting policy, you change the accounting estimates, or you might do an error correction. So all these needs to be elaborated and provided in detail to the reader. Because when a reader looking at a financial statement, they might not understand the reasons for the change, right? Unless those are like generic reasons, like say for example the business turnover coming down, right? Now say one classic example would be like if you look at the financial statements that are going to come in at the end of this year or maybe early part of next year, most of the companies might struggle because their performance compared to 2019 with 2020, they would have seen a drastical change. So the main reason was drop in turnover, mainly due to loss of business resulting from the COVID-19. Now, that has gone further, deteriorated further during 2021. So when you compare the financial statements from one year to the other, sometimes the reader might not understand the underlying reasons other than those of generic reasons. So when you go and do a policy change or a change in the accounting estimate, or you go and rectify an error, all those have to be disclosed. Disclosed in the sense you will have to provide additional information to the reader. The standard is intended to enhance the relevance, the reliability, and the comparability. Some essential features of the financial statements, which we learned at the beginning of this module, course module, or maybe even under LKS1, we looked at those. So what do we try to establish here? The relevance of the financial statement, the reliability of the financial statement, and the comparability of the financial statement depends heavily on the accounting policies that you establish. To what extent you use the accounting policy, which is governed by the accounting standards, to prepare your financial statements. That is where it is very, very important that the accounting policies play a pivotal role in the preparation of financial statements. So what are accounting policies? Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity. Now, when you look at an entity, they adopt certain accounting policies. And they go on to say that these financial statements have been prepared in compliance with these accounting policies. Whereas those accounting policies are prepared based on what is required by the relevant accounting standards. I'm not referring to this particular standard, but the respective accounting standards. For example, if you are accounting for property, plant, and equipment, you will talk about LKS 16. So from the LKS 16, what you have adopted and what are your assumptions. Okay. Then a change in accounting estimate is an adjustment of the carrying amount of an asset or a liability. Now I spoke about this. An accounting estimate, we call the depreciation rate to be an accounting estimate. Why? Now the requirement is there for you to provide depreciation. Every asset that is classified as property, plant, and equipment will require to be provided with depreciation. So when you provide depreciation, what happens? The carrying amount of the asset is going to change from year on year. Why? What is carrying amount or the net book value? It is the cost minus accumulated depreciation. So when there is an error or change in the accounting estimate to calculate the depreciation, automatically the carrying amount is going to vary from one year to the other. The same thing could happen with the liability also. For example, let me call it with the liability of gratuity, where people work in a particular organization for a certain period of time, where at minimum they need to cover 5 years. Once they complete the 5 year of service, they are eligible for gratuity. In the absence of pension, we call that as companies are supposed to pay gratuity to the employees. Now, this gratuity is a liability to the company, and that liability is going to continue. It's not a one-off liability. It is going to continue until the retirement or separation of the employee. So as long as the employee is in the organization, the company has a liability of gratuity. Now this liability have to be estimated. The liability has to be estimated. How do you do it? You have to do it based on certain assumptions. Based on certain assumptions. How do you do it? There are ways and means in valuation techniques, which we are not going to look at in detail because that's not part of your syllabus. So valuation is a special kind of activity. There are professional people to value the gratuity obligations. So what happens here, when a gratuity liability is calculated, and then later on in a subsequent year, when you go and change your estimates, right? These estimates will include the interest rate structure of the economy, the salary increases of the organization. There are so many assumptions. When these assumptions change, it has to be adjusted in the financial statements. Now, how you will change when there is an accounting estimate, change in accounting estimate, those will have to be adjusted retrospectively. Please note down, we call it as retrospectively. That means, let's say last year you had the depreciation of an asset to be 5 years. So you have been depreciating this asset for the last 3 years. Let's say last 3 years, you have been depreciating it for 5 years at the rate of 20%. Now, all of a sudden, your company decides this year to bring down the lifetime or the depreciation rate to 25%. So what will happen? Whatever you have been depreciating considering a period of 5 years, now it becomes 4 years. So when it becomes 4 years, you have to immediately adjust your financial statement for the entire depreciation. This is a must. This is a must. So that is why we call them as a retrospective adjustment. A retrospective adjustment. Very, very important. Right. So I would like to show you all accounting policy. Right. Now I'm going to share with you. I think this has been already shared with you all. Now look at this. This is an extract of the annual report of Hatton National Bank for the year last year, that is 2020. Now in that I'm looking at the notes, right? Now here you will see they are talking about accounting judgments, estimates and assumptions. Okay, so what are the accounting estimates, judgments, assumptions that they have made in the financial statements? So this is the section on judgments. What are the things that they have made judgments, right? I have not gone into the full extract of the financial statement. I have just taken few pages, but what I want to highlight is, like, just see here. Now they have talked about the COVID-19 pandemic also, right? Just read it for yourself. I just go through it. The COVID-19 pandemic and its effect on the global economy have impacted the customers, operations, and the group performance. Okay, you understand that. Why they want to say this? Because the financial performance of the company or the bank would have been impacted due to COVID-19. So how the COVID-19 has impacted? Yes, globally it has impacted. It has also impacted our own customers. And as a result, it has impacted the operations of the company as well as the group, right? So it also go on to say that the significant accounting estimates impacted by these forecasts and associated uncertainties are predominantly related to expected credit losses, fair value measurements, and the assessment of the recoverable amount of non-financial assets. So this is some extensive items that they are talking about, but basically what is important is like the financial statements are substantiated by providing this additional information. These are the disclosures, we call them as disclosures. That is what is important. Let me see whether I have another. So what I'm going to share now is the annual report of Commercial Bank for 2018, right? This is a copy that I had. I just want to show you all how the financial statements are presented, right? This is the first part of it. Yes, here you will see the going concern basis of accounting. So the accounting is done based on going concern. Then here you will see the section that I am talking about, functional and presentation currency. Functional and presentation currency. So what do they say? Items included in these financial statements are measured using the currency of the primary economic environment in which the bank operates. You see, that is known as the functional currency. Each entity in the group determines its own functional currency, and items included in the financial statements of these entities are measured using that functional currency. You see, so they are specifically mentioning how they have valued the items in the financial statements when it comes to foreign currency elements. Right. Then you also go on to say that what is the level of rounding, offset. Then we also talk about the materiality and aggregation, comparative information, how you have presented. And then they talk about the use of significant accounting judgments, assumptions, and estimates, right? I just want to show you all how they present the policies. Right. From this section onwards, they talk about the significant accounting policies. You see? Now you see significant accounting policies. The basis of consolidation. They talk about each and every items. Here, foreign currency translations. How you convert these. Then I just want you to look at how the depreciation. Right. Property, plant and equipment. Here they say details of property, plant and equipment. Now they have given it in detail in the respective sections. Right. Here you will see property, plant and equipment, basis of recognition. And here you will see, let me zoom a bit. The group applies the requirements of the Sri Lanka Accounting Standard LK 16 on property, plant and equipment. You see? So you have to give details about the accounting policy, which standard you have applied and how you have used it, what are the things that you have covered in your policy. Here you see cost model, revaluation model, everything has to be given. And here they talk about the subsequent expenditure. And these are the information that you need to provide for the financial statement. Okay. Right. Do you have any questions? If you have any questions, please ask.
Sir, in case of gratuity, now you mentioned about gratuity, no, sir?
Yeah.
So I have seen in some financial statements there's a term called provision for gratuity.
Yes.
Right. So anyway, now let's say now I join the company with effect from 1st Jan 2021. So
Okay.
sir, now relating to gratuity provisions, now how do we allocate this provision? Is it after completing 5 years, or because for entitled to entitle for gratuity you have to complete 5 years of completed services, no, sir? So
Yeah.
in that case, how do we do that provisioning thing? Is it from the date of joining or after completing of 5 years
No.
in accounting?
Generally the provisioning method is from the date of join. It actually starts, right? Because when you are doing the valuation, because now gratuity provisioning is actually you have to do something called an actuarial valuation, right? There is a professional body, there are actuarial valuers. You have to provide details to them and you have to get them to ascertain your liability. Okay, we can't in our own decide the liability. There is a method, a scientific calculation actually, right? They have to consider the mortality rate, as I mentioned you, the salary escalation rate, then the market interest rates. There are so many factors that they will look at. Now what happens here is when you provide details, actually the valuer will consider the liability from day one. But for the company concerned, they will pay it only for the employees who have completed at least 5 years of service. Okay. So making the provision and the eligibility is two different things. The making of the provision need not be as long as the employees completed 5 years. No, there is no such requirement. Provision can be from day one itself. But for to get the payment, they have to be eligible by completing the 5 years of service. That has a difference. That is, your provisioning and the payment of gratuity is totally different. One is a provision, the other one is a cash outflow. So don't mix up the provisioning and the cash outflow. Provisioning will be from day one. Cash outflow will happen only when the employee is eligible. That is, if they have completed 5 years of service. Does it answer your question?
So thank you. So in that case, so let's say now I join today, then after 1 year I will leave the company. Then
Yeah.
every year this has to be done, no, for accounting purposes, this valuation.
Yes. But on the other hand, when you leave the organization after a period of 1 year, you will not get the gratuity. So what will happen in the subsequent year, it will be a reversal for the company. Whatever the provision that they have made, they will just drop it in the subsequent year because you are no more in the company. So the provisioning will continue for employees, whoever continue to be there from 1 year to the other. Okay.
So thank you, sir.
Any other questions? Right. We are going to the next set of standards. Sorry. So next we are going to look at LKS 12 on income taxes, right? So by the way, you have to be mindful that these standards that I am covering are not required in detail, right? As per your syllabus content, you don't need to go into detail. That's why I'm not going into detail, because these are like, some of the standards are very complex. Now, if you look at income tax per se, income tax itself, you can learn it for 6 to 8 months, right? So what we are going to look at is only a synopsis of income tax, right? Okay, so LKS 12 covers the income taxes standard, and we are going to look at some of the details pertaining to income taxes. Right. So when you look at the income taxes, what do you mean by income taxes in the first place? Whenever you earn revenue, you make certain expenses, or you incur certain expenses also. And then you determine a profit for the organization. A profit for the organization. So when you earn a profit for a certain entity or an organization, there is a corresponding liability that you need to pay a certain percentage of your profits as income tax to the government. When I say government, it is the source of revenue for the government. Source of revenue for the government. So whenever you earn a profit, a certain percentage of that profit needs to go to the government, right? And the Inland Revenue Department will collect that tax on behalf of the government. The Inland Revenue Department will collect the tax on behalf of the government. So any organization which is earning a profit will have to bear a tax called, which we basically call it as income tax. But of course, when you look at financial institutions are attracted for more taxes. That is, we call it as value added tax on financial services. We call it as VAT on financial services. VAT on financial services. That is another tax. But what we are talking here is about income tax. Okay. So based on your profitability, you have to pay corporate taxes. This corporate tax only is known as income tax. Income tax. So under the income tax standard, there are a few definitions which we need to know. Out of which the first one we call it as the current tax. We call it as the current tax. What do you mean by current tax? The current tax is the taxes payable or recoverable on taxable profits. Now, when you make a profit, on that profit, you will have to pay taxes. That amount is known as the taxable profit. So, whenever you earn profits, of that profit, whatever is considered to be the taxable profit, on that you have to pay a certain percentage. You have to pay a certain percentage. For corporate companies, the tax percentage as of now is 24%. 24%. Okay. So when we say current tax, it relates to the taxes payable or recoverable on taxable profits relating to a fiscal period. When you say fiscal period, it is known as a financial year period, which needs to be paid to the tax authorities. The tax authority here is the Inland Revenue Department, right? Right. Now, as you know, for profitability, we talk about a financial year. We talk about a financial year, right? Now, this financial year, I hope you can see the board. Is it visible?
Yes, sir. Can see.
Right. Now, we talk about financial years, which are normally, we call it as 31st December companies, that is from 1st of January to 31st December, or you have 31st March companies. 31st March companies. So what do you mean by that? Their financial statements are prepared for a period of year from 1 let's say 2020 to 31 12 2020. And if you take this example, this is from 1st April 2020 to 31st March 2021, right? So now these two types of companies will ascertain their profits. Ascertain their profits for this period. It could be a profit or a loss, we don't mind, but you ascertain your profits for this period. Now, based on these profits, you are required to pay tax. Whatever the scenario is, you have to pay taxes. But what do we need to understand here is, for tax purposes, we have something called a tax year. Now, the tax year is very common. Whether you are a company of this type or whether you are a company of this type, the tax year remains the same. The tax year remains the same. How does it work? It goes from 1st of April any year, right? Let's take, I don't put it as a particular date. Let's put it as April 1st to 31st March. You see? That is how it goes. April 1st of one, starting in from 1 year, and it will go on to 31st March of the very next year. This is how the tax year works. Tax year works. So it is common, whether you are an individual or you are a company, a special purpose entity, whatever you may call it, for any person, this is the tax year. And based on this only, they will determine your payments also. Payments also determined on this basis. On this basis. Is that clear? So you can just take it down for your purpose. Financial years are could be 31st December or 31st March, but the tax year is 1. Please take down. Okay. Below that you can take down. Below that you can take down. According to this tax year, according to this tax year, according to this tax year, corporate entities, corporate entities, corporate entities, and individuals, and individuals, and individuals are required to make, are required to make, are required to make income tax payments, income tax payments, income tax payments to the inland revenue authorities, to the inland revenue authorities. Let me write it. Inland revenue department. We call it as Inland Revenue Department. Huh? IRD. To the Inland Revenue Department or authorities, whatever you may call it. To the Inland Revenue Authorities on a quarterly basis. On a quarterly basis. Okay. So what you need to do, you need to make tax payments on a quarterly basis to the Inland Revenue Authorities. And what are the dates? That is very important. Right? So the first quarter, Q1, falls on 15th of August. Right? Q2, 15th of November. Q3, 15th of February. And Q4, 15th of May. Right? So these two are in one particular year. These two are in the subsequent financial year. Okay. So probably the final payment that is not relevant because now it is expected to pay by 4 installments. So we'll leave it at that. Okay. So there are 4 quarterly installments. Say if you have 15 million of say not 15 million, let's say 20 million of tax to be paid. So 20 million divided by 4. How? Each quarter you will pay 5 million. That is how. Okay. Each quarter you will pay 5 million. Right? Okay. Let's go back to the slide. So the current tax is basically the income tax that you are supposed to pay. That is on your profitability. But we also talk about another type of tax, which is known as a deferred tax. A deferred tax. Now this deferred tax is something where you have to calculate or compute for accounting purposes, but the realization of this particular tax, will happen at a subsequent date. This is something different to the income tax, right? This is also built in within the income tax scope, but it's a different type of a tax. Now, what do you mean by deferred tax? These are tax adjustments which are needed in the financial statements due to temporary differences. We call it as temporary differences between accounting base and the tax base of assets. It could be also liabilities also, but generally it is due to the temporary differences between accounting base and tax base of assets, or we call it as accounting profit versus taxable profit. Okay, I will explain it in detail. And these taxes may be payable in future periods. You see? So that's what I said. Now, these taxes are calculated using scientific methods, but you will pay them not in the current year, but maybe in a later period. Maybe in a later period.
If you can give one example for deferred tax, current tax is income tax, but
Yeah.
in case of deferred tax,
No,
any
I'll go into detail because my next slide will talk about that in detail. So when I go to that, I'll explain. Before that, we will cover these 2 points and then we'll go to that point. Okay. So when you look at the accounting profit, that is the profit reported in the income statement based on accounting standards. Now, when you talk about the accounting profit, you know that now we already learned that the financial statements are prepared based on accounting standards. In addition to that, we make certain assumptions. So the profit that you are calculating or you are determining out of your financial statements are based on several assumptions and estimates. Do you agree with that? Your accounting profit that you determined is based on certain assumptions and estimates, right? But there is another concept called taxable profit. There is another concept called taxable profit. Now, what is this? The profit calculated based on tax rules. What do you call by taxable profit? Taxable profits are the profits calculated based on tax rules in a jurisdiction. In a jurisdiction. Now, this is where we have to be very careful in understanding the income tax and the deferred tax. I'll explain you what it is. Right. Now, we take a simple fixed asset. Right? That is the best example that I can give. We'll take a property, plant, and equipment. Right. And in this, we are going to take the example of a computer. Going to take the example of a computer. Right. Now, the cost of the computer is, let's say, 200,000. 200,000. Okay. I'm just assuming that this is 31st December 2020. Right. The accumulated depreciation, okay, the accumulated depreciation. Now let's say we have used this asset for 3 years. We have used this asset for 3 years. According to the company policy, the useful life is, let's say, 5 years. Right? So, accumulated depreciation for 3 years. Let's take 3 years. Accumulated depreciation for 3 years. What is the amount? Tell me quickly. Accumulated depreciation. Don't worry about the date of purchase and so on. Just consider the annual depreciation and tell me what is the depreciation for 3 years. How much? How much is it? Come on, we did it last week. What is the accumulated depreciation of this asset for 3 years? Okay, use straight line method. Don't worry too much. Use the straight line method. How much is the depreciation? How much? 120,000. I hope everybody got it correct. 5 years, 200,000. So 200,000 divided by 5, you get 40,000 per year. 40,000 per year into 3 is 120,000. Now, what is my carrying amount or the net book value? $200 minus 120, I get 80,000. I get 80,000. Okay, this is what my accounting based numbers for the financial statements. Okay, so in other words, when I calculate my profit, I have considered 120,000 into my financial statements. Okay, now this is called accounting base. Accounting base. Okay, accounting base. So accounting base means what? I have the cost with me, the accumulated depreciation based on the useful life of 5 years, which is my estimate. I have calculated the depreciation, and this is my carrying amount. Now let's talk about another scenario. The cost is 200,000. Now let's say the useful life is not 5 years, but the useful life is 4 years. 4 years. Now quickly calculate the depreciation. Accumulated depreciation. What is the accumulated depreciation for 3 years? 150,000. Very straightforward. 200 divided by 4 per year, I get 50,000. 50,000 into 3, I get 150. Now what happens with the carrying amount? My carrying amount is 50. My carrying amount is 50. Now you see, this is what your accounting base is, and I gave you an option to calculate it at the rate of 4 years. You end up at 50,000. Now you create a difference. Now what is this difference? That is what we need to know, right? So how this difference arises? Now you know that this 120,000 was arrived at using a useful life of 5 years. And you also know this can differ all the time. When the company thinks this is not 5 years, I can put it to 6 years, they will change it to 6 years. If they think this is not 5 years, is not sorry sufficient, they can make it 10 years. Nobody can question it because it is the company policy. But what the Inland Revenue Department says, whatever the useful life you use, I don't mind. I'm not bothered about it. You need to use 4 years as the useful life when it comes to computer. I'm just taking an example, right? So now you take the point. Because what happens here, when you look at the useful life here, what the company may use, the company has the option to manipulate this number all the time. Depending on the company's requirement, the company can change this useful life as and when they want. So the Inland Revenue Department doesn't like that. You cannot be making your profits vary by changing this number. You can't do that with me. Inland Revenue Department says you have to apply a constant useful life when it comes to this asset, so that your profits are not distorted. So that your profits are not distorted. So the Inland Revenue, what they have done is, for each kind of asset companies can have, they have a predetermined useful life. Okay, we call it, or rather I can say that it is not the useful life. They come up with a rate of depreciation. That rate of depreciation is known as, rather I would call this as economic depreciation. Economic depreciation. So the Inland Revenue is not bothered to listen at whatever the depreciation that you put. No, we don't want that. Please remove this and put the number that we give. You need to calculate based on that for tax purposes. For tax purposes, not for accounting purposes. For accounting purpose, you can do this. You prepare based on this and show it to your shareholders, stakeholders, everybody. We are not bothered. When you are paying taxes to us, your accounting, your profit should be based on our economic depreciation rates, right? So that is how the income tax calculation actually happens. But when you apply those type of rates, what happens? The accounting base and the tax base, we call this as the tax base. Those two will have a difference like this. And it will be keep on changing. Keep on changing. But at one point, what will happen? Both will be equal. Both will be equal. So until such time, whatever the differences that you will have in the accounting base and the tax base is known as the temporary difference. So the Inland Revenue Department says, whatever the temporary difference that you have, on that you provide deferred tax. That is the logic. Okay, so you have an accounting base, you have a tax base. So on your accounting profit, we don't want to tamper anything. But on your accounting profit, you do certain adjustments and pay us the correct income tax. In addition to that, whatever the differences that you may come across with the accounting base and the tax base, on that temporary difference, you create a deferred tax. You create a deferred tax. Right? Actually, this is not deferred tax. You have to apply the tax rate. You have to apply the tax rate. That is 30,000 into 24%. Now currently it is 24%. Previously it was 28. Now it is 24%. So 30,000 into 24% is your deferred tax. Okay? Right. So please take down.
So excuse me.
Yes, go ahead.
So here this tax base example, it says cost is 200,000, then
Yes.
minus depreciation is 160,000. No sir?
50, 150.
150, no? Okay, sir.
Yeah.
Thank you.
Okay, below that you can take down. The income tax will be computed. The income tax will be computed within brackets. You can say current tax. Huh? That is current tax. The income tax, we call it as income tax. So the income tax is computed based on the guidelines. Based on the guidelines issued by the Inland Revenue Department. Next line. In accordance with these guidelines, deferred tax, deferred tax needs to be calculated needs to be calculated needs to be calculated on any temporary difference, on any temporary difference, on any temporary difference at the stipulated rate of income tax, at the stipulated rate of income tax, at the stipulated rate of income tax. Okay, so what does it mean? Income tax will be computed based on the guidelines issued by the Inland Revenue Department. On top of that, when you follow those guidelines, there may be situations where there is a difference or the temporary difference between the accounting base and the tax base. So whenever there are differences of that kind, for those temporary differences, you have to provide deferred tax at the rate of prevailing income tax rates. Okay, so in this example, I have taken this 30,000 as the temporary difference, and there will be a 24% on that 30,000 will be considered as deferred tax. Okay. Right. So how these taxes will be adjusted is in the statement of comprehensive income, you will have taxes for the year. There could be over or under provisions, and there has to be an adjustment for the deferred tax. Okay, that is on your P&L. On your P&L, you will have that income tax, that is current tax for the year. There could be adjustments for the over or under provisions. If you have provided more in the last year, you can reverse it in the current year. So those adjustments can be there. On top of that, you need to make adjustments for the deferred tax as well, right? That is on the P&L side. On the balance sheet side, that is the statement of financial position. On the current tax, what will happen? You will debit your P&L and credit the tax payable. You will debit your P&L and credit the tax payable, that is the liability. When it comes to deferred tax, it is also the same. You might debit your P&L or credit your P&L, and correspondingly, you will have a deferred tax liability, or it could be a deferred tax asset. Okay, there are both the options are, or the situations may arise. Both the situations may arise. So these are some of the instances, where the tax base and the accounting base may differ, right? For example, the depreciation. Accounting depreciation versus tax depreciation. That is the economic depreciation that I was talking about. Then you will have what we discussed earlier, the gratuity liability. The gratuity liability. So we call that as the current service cost. The current service costs, depending on the current service cost, you will have differences on the gratuity that you pay. Then, most importantly, you should know the interest income. The interest income. What will happen? There might be a situation where you will do accrual basis of accounting versus cash basis accounting. That is also very, very important, because most of the time the Inland Revenue Department will permit the cash basis accounting. Okay, so those differences also might end up in providing a deferred tax. Okay, so basically that is about taxes. We don't need to go into details much about taxes. It's only that you need to know where these components will appear. So the income tax and deferred tax, whatever that is supposed to go into the P&L will come into the P&L. And the corresponding entry of the income tax or deferred tax will be reflected in your balance sheet as a liability, or sometimes it could be a deferred tax asset. Deferred tax asset. So we come to the last topic on this, that is inventories. Inventories is the stocks. We are talking about the stocks. So stocks play a very, very important role in companies, you know. So under sole proprietorship, we learned about this. You have opening stock and you have closing stock. Why it is important? Because it has a direct impact on your profitability. It has a direct impact on your profitability, because when you value your stocks incorrectly, it is directly impacting your cost of sales. It is directly impacting your cost of sales. I hope that you can remember, when you are calculating the cost of sales, what do? You take the opening stock, add purchases, deduct purchases returns, and deduct the closing stock. So you have to be very, very careful when you calculate the value of the opening stock as well as the closing stock. Now we talk about this in terms of stock, but when you put it onto an accounting standard, it is same as what is mentioned as inventories. So LKS2 is basically covers the standard on stocks. In other words, it is the inventory. So the standard prescribes the accounting treatment for inventories, that is stocks. It describes the amount of cost to be recognized as an asset and carried forward until the related revenues are recognized. Now, say for example, you are in a production line, you produce finished goods, right? Let's say you are a manufacturing company and you have produced t-shirts. So you get 500,000 stock of t-shirts. Now you have to value this. When you are maintaining a stock, you have to value it. It's not the number. You can't have 500,000 numbers of stock. That is your control. But there has to be a value. Then only it can be put in the financial statements. So how do you determine that value? That is what we are going to learn today. The standard provides guidance on the determination of cost and its subsequent recognition as an expense, including any write-down to net realizable value. It also provides guidance on the cost formulas that are used to assign cost to inventories. So the standard applies to all inventories except the following. What are those? Work in progress arising under construction contracts. So you can remember, when it is construction contracts, it is handled by a separate standard. Under PPE, I mentioned it. Financial instrument is the biggest topic that we are going to learn next week. Then, as I told you, the biological assets related to agricultural activity. Then the standard does not apply to the measurement of inventories held by producers of agriculture and forest products, commodity brokers. Those two are some of the inventory holders, right? So the standard does not apply to certain inventories, and the standard does not apply to the measurement of certain inventories, right? Now, if I'm to recall something which we learned, somebody having a plot of land, right, divided into small units. Now this is also like a stock. Will it come under LKS2? What do you think? A plot of land divided into smaller units or parts, will that be covered under LKS2 inventories? What do you think? Any answers? No. Why? When you say no, there has to be an answer. Why is that? Because it is covered under a separate standard. It is covered under a separate standard. That is investment property. That is under investment property. You have to remember. So the relativity that you learn has to be in place. You have to connect with each other topic that we learn. Then only you can understand and relate what you are learning. Right. Scope. Sorry, that we have already looked at. Definitions. Assets held for sale in the ordinary course of business are inventories, or in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process. In simple terms, inventories are finished goods, work in progress, and raw materials. Okay, so please remember, your stocks can take three forms. What are the three forms? It could be a finished product, okay, or it could be a product that is being made in the process, that is called work in progress, or it could be the raw material where you have brought in wood, that is raw material. When the wood is cut, that is a work in progress. When you complete it as a chair or a table, that is your finished good. So you understand that the stocks can arise in three instances. One is at the stage of raw material, second at the stage of work in progress, and finally at the stage of finished goods or the trading stocks where you put to the showroom or your shops. Right. So considering these three stages in which your stocks can be, there are two mechanisms of valuation. Either you can consider the stocks at fair value, or you can consider at net realizable value. What do you mean by this? Fair value, of course, you know all by this time. value at which an asset will be exchanged or liabilities will be settled between a knowledgeable willing buyer and a willing seller. I have already spoken about this several times, the fair value. But what is net realizable value? The estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. Okay, so this is somewhat a value that you expect from selling a product less its cost to completion. Okay, something like similar to a profit from the sale of the product. So how do you take the value? According to the standard, it says you need to consider the cost or the net realizable value, whichever it is lower. Whichever it is lower. Now, why it is lower? Why it is lower? Because if you take a larger value, your cost of sales will come down. Your cost of sales will come down. Parallelly, you will have a larger asset value in your books. If you overstate your stocks, you will have a larger value in your assets or in your books as assets. So the accounting or the standard doesn't want that to happen. You have to always reflect what is the true picture is when you're preparing financial statements. Right. Now comes the cost formula. So this is very generic. When you want to do stock valuation, there are certain methodologies. I think you might have already heard about these, but still, for the benefit of everyone, we have to do this. Stocks can be valued in several ways. One of the most popular method is, we call it as first in, first out. We call it as first in, first out. That is FIFO. The second most common method that is used is the weighted average cost method. We call it as WAC, weighted average cost method. What else? What are the other methods that you know? Any other methods? Any other methods that you know? No answers. Okay. Another method that is popular is called the Lifo. Last in, first out. Last in, first out. That is also somewhat a method that is widely used. But when it comes to the cost valuation or the inventory valuation, these two are the most common and popular method. First in, first out, and weighted average cost method. Right. So how we are going to learn this is by way of an example. So I want you all to look at this question that is given here. You can see what has been given. Right? Now this is a company, MSQ Limited. They have received some goods. Now this is their finished product. So their finished product, they receive it on different dates. 10th May, 18th June, 3rd of July, 12th of December, and they have these products at different unit prices. You see, 1,500 units at 5 rupees each, 1,750 at 8 rupees each. Likewise, you have. Okay. Then what happens? You are issuing goods and you are issuing at different dates. 11th of June, 20th of July, 20th of December, very different volume of units, right? Now the question here is, what is the closing stock valuation? You can take down the question. What is the closing stock value based on the following methods? What is the closing stock valuation based on following methods? One is FIFO. I have done a table. Right? Is it visible to you all?
No, sir. The letters are not visible. It's too small.
Okay. So what I have done is I have divided this into basically 8 columns. There are 8 columns altogether. First one is the date of the transaction, right? That is here. Then we have units, that is number of units, price per unit, and the value. Then similarly, again I have units, price, value. Now here what we say is the purchase. It is the purchase, because the question says they have purchased units at different time periods. Then we have the issues, how they have given it, right? And here we are going to maintain the stock value, right? Is that clear now? Again, I'm repeating. We have purchase, issues. Then we have on the first column, we have the date. Under purchase, we have 3 columns: units, price, value. Then again under issues, we have 3 columns: units, price, value. Then we have the stock value column. Actually, there also we need to have 2 columns. Let's divide it into 2. Units and value. Units and value. You can put down the table.
So if you can repeat the issues columns again, sir.
Units, price, value. Same columns. What you have under purchase is again going to be repeated. Units, price, value. And the last one we have closing stock. Under closing stock, we have 2 columns, again units and value. We don't talk about the price. Okay. Right. Now we are going to look at transactions one by one. On 10th of May, 10th of May, you have received 1,500 units, 1,500 units at the rate of 5 each. That is 5 rupees, right? 5 rupees. So what has happened? 1,500 units at 5 rupees. By the way, I forgot to tell you, we are trying to do under the FIFO method. Under the FIFO method. We are using the FIFO method now. Okay? Right. So 1,500 units at 5 rupees means 7,500. 7,500. So basically, these are nil. So what you have as the closing stock at this point is going to be 1,500 units at 7,500. Right? If you want, you can maintain, but it doesn't make sense because later on you will see there will be multiples. Okay, so we have recorded the first transaction. You can tick the first transaction. Now we go to the second transaction under receipts. But you see, under receipts, the transaction is happening on 18th June. 18th June. So again on 18th June only you are receiving goods. But prior to your receipt, there is a issue happening. When is that? That is happening on 11th June. Now comes the problem. Now, what do you mean by under first in, first out method? First in, first out method. What do you mean by first in, first out? First in, first out means in a company, the products are sold on the basis of first in, first out means whatever that comes in first has to be sold first. That is what it means. Whatever that has come first, it has to be sold first. You can't all of a sudden take the last one and sell it. That's wrong. So you have to always go by what has come first. From that only you have to sell also. So now in this question, you are getting or you have something coming on the 10th of May and again on the 18th of June. But in between those two, there is an issue happening on 11th June. 11th June. So 11th June, what has happened? You have issued 1,200 units. 1,200 units. 1,200 units. 1,200 units. Now these 1,200 units will go at this price. Why? I have only this stock up to now. So what has come first has to go out from this. Whatever that has come first has to go out from this. So these 1,200 units will go at the price of 5, which will be 6,000 rupees. 6,000 rupees. 6,000 rupees. Right? So now what is going to happen? Prior to this transaction, I had 1,500 units. Now I am giving away 1,200. So what will happen? Only 300 will remain. Only 300 will remain. Prior to this transaction, I had 7,500 rupees as my stock value. But out of which 6,000 is going now. 6,000 is going now. So 7,500 minus 6,000. Okay. Now your closing stock is 300 units at 1,500 rupees. How did you get this? It is 300 units at the rate of 5 rupees. So up to now, from the stock I had of 1,500 units, I have sold only 1,200. There is 300 remaining from the stock of 1,500. From the stock of 1,500. So you have to remember. So if you want, you can just mark this at 5 rupees. The closing stock is at 5 rupees. The next transaction is on 18th June. On 18th June, I am getting another 1,750 units at 8 rupees. At 8 rupees each. How much is that?
14,000.
14,000. Right. Now what happens? Now I had only 300 units. 1,750 came. So it becomes 2,050 units. 2,050 units. I had 1,500 in value. Now 14,000 came. So my value goes into 15,500. 15,500. But the problem is now you can't have a fixed price. Why? It is a combination here. It is a combination. 300 units at the rate of 5, 1,750 units at the rate of 8. That is where the problem is. Okay. Again, there is another transaction which is happening on 3rd of July. 3rd of July. How much is that? 2,750 units at the rate of 10 rupees. At the rate of 10 rupees, which means 27,500. So now 2,050 units plus 2,750 will give me 4,800 units. 15,500 plus 27,500 will give me 43,000. +27 plus 15, yeah, 42, 43. So currently now I have 4,800 units at 43,000 rupees. 43,000 rupees. 4,800 units at 43,000 rupees. Now comes, there is an issue of 3,000 units on 20th July. 3,000 units on 20th July. Now here only you have to be very careful. Now the question is how you are going to issue this 3,000 units. How you are going to issue this 3,000 units. So this is where FIFO comes in, first in, first out. First in, first out. So you know, inside this 4,800, you have 300 units remaining, which is at 5 rupees. Am I correct? Inside this 4,800 units, you had 300 units which came at the value of 5 rupees. So what I'm going to do first is to remove that first. On 20th July, I'm going to remove that 300 units at 5 rupees, which means I will remove the 1500. So here I will have 4200, sorry, 4500, and here it will be 41,500. After that, what is remaining here as 4500 is 1750 plus this 2750. So out of which I will remove 1750 first. That will be at 8 rupees. So will give me 14,000. Sorry, this has to be negative. Then, which means 2,750 will remain at the rate of 27,000. Okay. So now what has happened? On 20th July, I am required to issue 3,000 units. Now I have only issued 1,750 plus 300. So which means that is 2,050 units. So I need to issue another 950 units. Another 950 units which will go out from this. And that will be at 10 rupees. Okay. So when 950 units goes 1,800, and it will be 18,000. And the last two transactions on 12th of December, you are getting 2,500 units at the rate of 12. How much is that?
1,000.
30,000. So that will give you 4,300 units at 48,000. It will be at 48,000. Now I have 4,300 units, which is a combination of 1,800 units of this and 2,500 units of this. Okay. And the last one, an issue of 20th, is it? Yes. 1,300 units. So 1,300 units means I have 1,800 units here. So from that I can issue 1,300 units.
So this 1300 at the rate of 10 rupees, no sir?
Yeah, because this 1800 units that is remaining is from this. So I have to retain it. Okay. So your answer will be 3000 units and the closing stock value is 35,000. Okay. Right. Now, suppose if this question comes as a multiple choice question. Okay. The same question can be given in the form of a multiple choice question. How are you going to answer? Can we do all these? Because if you try to do this, it will take a lot of time. You need to put up a table, put down figures one by one. So it takes a long time. What can we do? What is the shortcut? So the shortcut method is you look at the total number of units issued. Total number of units issued. How much is it? How much of
8,500. 8,500, sir.
no
No, the 5,500, sorry.
5,500 totally. So with the, I am not referring to this, sir. Based on the question, looking at the question, you know, total issue is 5,500. Now, if I am to use the FIFO method, if I am to, please carefully watch this. If I am to use the FIFO method, what should I do? I have to issue this 5,500 from this order. Am I correct? I have to issue it from this order. This, and then this. Right? So from 5,500, if I am to issue, what will happen? 1,005 fully will go. 1,750? Yes. Then what will happen? 1,005, 1,750 means 3,250. How much more I will need?
500.
No. To make it 5,500, how much more I will need? Another 2,250 I will need. Correct? Now the total number of units issued is 5,500. From this 5,500, I will start issuing from here. 1,005 will go out. Fully will go out, right? Then you will issue this 1,750 also. By this time, how much you have issued? 3,250. Correct? To make it 5,500, how much more you will need? Another 2,250. Correct? It will be 5,500. Understood? So if I am to issue 2,250, what I will use is this. How much will remain?
500.
500. So this plus this will remain. Am I correct? After issuing this 5,500 on FIFO method, this 500 plus this 2,500 will remain. Correct? Yes or no? Yes or no?
Yes, sir.
Yes. So that is what this 3,000 units is. Did you get it? Right? Now we look at the value. Now 500 units is remaining from here. How much is it? Per unit? 10 rupees. So 10 rupees into 500 is 5,000. Correct? This 2,500 entire 12 rupee units are remaining. So that is 30,000. How much is it? You get the answer. Okay. So when you are answering it for a MCQ, you need to do the calculation in this manner. You can't be going and doing the long method because this will take about 10 minutes of your time. You can't do that. So you have to simplify it. How to simplify? Look at the total issues. Then take it here, knock off one by one. So this will go off entirely. This will go off entirely. Of this, I will take only 2,250. As a result, 500 will remain. This 500 plus 25 will give me 3,000 units. 500 at 10 rupees, which is 5,000. 2,500 units at 12 rupees will give me 30,000. So my value is 35,000. So your answer will be 3,000 units at 35,000 rupees. Okay. So what we have done is actually the FIFO method. Please go through it again. When you come next week, I will complete the average cost method next week, and then we will get on to the most important topic of financial instruments. So please do not miss that class. The next few classes, that is the maybe say 3 to 4 classes that we are going to have, will be very, very critical. The most important topics that we are going to cover, one is financial instrument, the other one is statement of cash flows. Okay, so it's almost 5:30. Please do revise of this particular question that we did on FIFO. We will do the weighted average cost method next week. If you have an idea, just try to do that question on weighted average cost method so that you can check with me when we do it in class. Okay, right. Take care.